Once again, thank you so much, ladies and gentlemen, to be here on time and also early. And today we will be here to talk about the upcoming IOP, initial public offering of the ETF China, MSCI China A50, which comprises of 50 China's leading companies. And today, who we have here is Mr. Tan Teck Leng, who is a Deputy Chief Investment Officer from PhillipCapital. He will be sharing with us a little bit more about the whole China thesis and everything. Feel free to ask any questions that you have along the way, either in the chat box or in the Q&A box as well. Without further ado, I'll just pass the mic to Mr. Tan. Thank you.
Hi, good afternoon. Thank you for attending this webinar. So basically, this is an ETF that invests into A shares. That means the domestic exchanges, Shanghai Exchange and Shenzhen Exchange. So it gives exposure for the investor to the 50 leading companies on the China mainland exchanges. Yes, I think this will be done along a fireside chat format. So please go ahead, Mumi.
Okay, so I think one of the key questions that people are generally thinking, especially the investors today, is that currently China's economy is declining slightly. At the same time, the market hasn't been doing well for the past like 2 to 3 years. So what are some of the reasons why people should start investing in China this season?
Yep, thank you for that question. Yes, I think that is a common impression when people look at a China investment nowadays. They think about the headlines that they have read. And of course, headlines tend to be crafted to draw attention. So, naturally, it tends to be the case that what draws attention is bad things, right? Yeah, or extremely good things. But in this case, China, of course, it has been experiencing the real estate slowdown, right? That's one. Not slowdown, of course, collapse actually in some of the private developers. And that has led to a slowdown in the overall economy because people feel a bit fearful, especially when real estate is typically one of the bigger investments in one's portfolio, right? And add to that, I think the geopolitical tensions that have been well printed over the past few years, right? Starting from Donald Trump's time until now, right? Well, I will talk today about some of the key things that probably an investor should consider when looking at China. And what I want to highlight, first of all, is that some of these headlines lead people to sell. So when people sell, there is a weakness in the market, and is that weakness worth taking advantage of? So this should be the key question in your mind when you look at my next few slides that I'll be talking about. I believe that you probably can see the slide that I'm sharing on screen. So without further ado, I'll just talk starting from here. Do feel free to let me know or let Mumi know if there happens to be any problem with seeing my slides or the visual part of it. Okay. So first of all, I think what we need to note is the track record of China over the last 3-4 decades. That growth track record and the size of it right now. On the left-hand slide, what you can see is that China today contributes about close to 20% of the global GDP. And that is almost comparable to the US, which is the one in blue, right? The one in red is China. And that basically makes China the second biggest economy in the world right now, right? But if you look at the GDP adjusted for purchasing power is already the largest. Why is purchasing power adjusted? Also called PPP adjusted GDP, which is the one that you see on the right-hand side. In currency terms, it basically means the GDP that somebody in China, what can they use that GDP that is generated in China to purchase a basket of goods within China itself, right? If that unit of GDP in China is actually able to purchase a bigger basket of goods compared to a unit of GDP in the US, for example, in comparison to one unit of GDP in the US that is able, and how much it can buy in the US, right? If that basket in China is bigger, then definitely purchasing power adjusted wise, the GDP for China would be bigger. And then that comparatively, the PPP adjusted GDP for the US will be smaller. That's how basically you adjust for purchasing power adjustment. Basically, in other words, the purchasing power of that nominal GDP that you see in the first chart, right? So if you adjust for that, you can see that the red one, which is China, in PPP adjusted terms, is already the biggest consumption nation in the world in terms of by consumption power since 2016, right? 2016 was the year when both of them were roughly equal. And then since then, the red bar, which is China, has exceeded that of the US in PPP adjusted terms. Now, to get another perspective, and this in this case is the size of the capital markets, namely the stock market. The left-hand chart basically shows the top 10 global stock markets ranked in terms of the size, the total market value of the stocks listed inside the respective exchanges, right? So in that sense, what you can see is that the two red highlighted ones, which is the two domestic exchanges of China, Shanghai Exchange, which is ranked 4th, and Shenzhen Exchange, which is ranked 7th. Together, adding up together, they add up to about over 10 trillion US dollars in the total value of stocks listed inside these two exchanges. Right? In fact, if you were to add Hong Kong Exchange, which is the 8th ranked one, then it would be 13 trillion. Yeah. So that's why that's why not just GDP, but in today, China's stock market is also, if you add the Shenzhen X Shanghai together, China's stock markets are also the second ranked in the world. Just the A shares alone, right? The domestic exchanges, which is referring to Shanghai and Shenzhen. The chart on the right-hand side basically shows how that number compares versus the country's GDP. And the red one basically shows China. So that number as a percentage of GDP is something around 80% of GDP. And that is relatively low compared to, say, a market like the US, where that number is close to 200%, right? So the corollary from that is basically that there is still more room for growth, probably through maybe the size of the market, through new listings, companies that that are in the country but haven't listed yet, or maybe also the size, maybe the valuations of the market, the companies in the market itself. Right. So that's the size of the GDP, the economy, size of the capital markets. Now, what does that really mean, right? Why do I show that? Right? Size itself is important because it also gives an idea of the critical mass of the country in terms of the ability for consumption, right? For example, there is probably also a accumulated critical mass of savings and investments as well, right? Accumulated over the years through high GDPs. So now you know that China is trying to transition to a so-called dual circulation economy. So not so focused on just exports and manufacturing, but also on internal consumption, right? And one of the considerations is therefore, can they undertake this transition properly, right? Well, I believe that by sheer size alone, they're already world's second largest. So I think that gives some optimism that this transition will be relatively not too bad, right? Since there's already a critical mass. Secondly is the growth track record, right? So the growth track record wise, I think you can appreciate already, as I've talked, that China's growth track record is there for all to see over the past 3-4 decades. They have carried hundreds of millions of people out of poverty, right? So I wouldn't bet against them, right? through the current doldrums. So that's size. Now, there are also a few other things that I want to highlight about the case for investing in China. Secondly, that would be diversification benefits. So if you see the chart that I'm showing here, MSCI China A shares is the last row, it's the one to look at, right? So versus S&P 500, FTSE UK, the France CAC stock index, and so on, you can see that the correlation, which is typically used to measure whether a market moves very closely with another market or not, right? The correlation is relatively low. So anything basically for reference, any correlation that's below 30% would be considered relatively low correlation. So in this case, because the MSCI China A shares, right, which are used as a proxy to measure China's domestic stock markets, because that correlation is quite low against the major stock markets, so that can be considered as a way to buy an equity market that has relatively less correlation and therefore more diversification benefits versus the other major developed markets. Valuations, well, valuations, I think you will appreciate for yourselves. Well, China's market has dropped a lot, so I think it wouldn't be surprising that today it trades quite cheaply against major markets such as the S&P 500 or maybe the Nikkei, both of which are above 20 times PE. Well, in comparison, MSCI China A50, which again are used as the reference for China's domestic shares, well, that trades at below 10 times PE, right? So that's a relatively low valuation level. Well, lastly, catalysts, right? So catalyst-wise, I think it's worth highlighting or considering two things when thinking about whether is this a turning point, right? Is this the time to buy right now? Because I think some people, there's always the back of your mind whether is it a value trap, right? It is cheap, but can it go cheaper, right? Because conditions are bad, so would it go worse, right? So when you think about this, I think there are two angles that investors could consider. Firstly, the capacity of the country to boost the capacity of the country to boost the economy. Secondly, the willingness of the government to boost the economy, right? Or has it got other priorities? So definitely, if you look at this slide, you appreciate that capacity-wise, the government is in a good position if it wants to do some major stimulus to boost the economy, boost the market, right? For example, on a forex reserves basis, China's forex reserves is the world's largest at over $3 trillion US, right? And basically, of course, forex reserves are earned when your exports are more than your imports, right? And that basically has been the case for China since the last few decades because of its manufacturing exports, right? So they always earn more than they pay out in terms of the forex. So that enables them to accumulate these reserves. Secondly is the government debt, which is the chart at the bottom, right? So typically government debt as it is measured against the size of the country's GDP, which is what is shown here. So in this aspect, you can see that China on the left-hand side, that number is relatively benign, right? At 83% of GDP for government debt, versus a lot of other advanced economies, right? Such as US is 123, and well, standout is clearly Japan, 255%. Capacity is there. So in terms of capital, China does not lack capital. But are they willing to do stimulus? I think that has been a key question for the last few years because people have been expecting them to, for example, the 2008 GFC, global financial crisis, the Chinese government was quite aggressive in introducing stimulus, right? Mainly infrastructure and construction stimulus to boost the economy after the global financial crisis in 2008. So this time people were looking at that as a possible catalyst, but it hasn't really happened because I think the China government has had other priorities over the last few years. as you read, things like they were trying to ensure that there is deleveraging because they felt that debt levels, especially for property, was rather concerning. So if you look at the property development, the developers' situation today, I think some part of it can be attributed to the government's deliberate breaking of the property bubble, right? Other things that the government was focusing on was trying to navigate the geopolitical crisis. I mean, not really crisis, but the geopolitical troubles with the US, right? Trade war and so on, right? And basically, they had also been focused on regulating the mega cap companies, such as the tech companies and so on. You may want to look at the recent measures that the Chinese government has and central banks have been doing, because I think there is some evidence that they are actually looking at more urgent measures to boost the markets, as the stock markets in China have weakened quite a fair bit over the past few months. So the urgency is there. And why the urgency? Because besides real estate, right? So a lot, the key investments of mainland China retail public would naturally be also in stocks, right? And what kind of stocks? A shares, right? Mainland shares. So that is why the government is concerned, because if the wealth effect is not there, people feel poorer because of cheap, lower real estate prices, and add to that lower stock prices. Then of course that may affect the government's overall strategy to encourage the dual circulation economy. So there is some of these considerations that is leading to the more aggressive policy measures over the past few months. Things like the central bank cut the bank's reserve requirement ratios. What that means is basically that the banks are now required to hold less cash in their reserves on their balance sheet. They are allowed to lend out more borrowers. Right? Fiscal policy. So fiscal policy wise, the government has been more proactive in terms of planning for a budget deficit at 3% in their latest 2024 budget. That basically means that the government is planning to spend more than it taxes, right? It spend more than it takes back from the people. There is a plans for a 1 trillion yuan financing for affordable housing programs. So basically that's in reaction to the troubles of the private property developers. So other measures would be, for example, trading restrictions to limit short selling. And then also on the demand side, they have also leaned on some of the state affiliated funds to boost the market by buying stocks on the open market. Some of these, I think, it is basically indications of a possible catalyst. I think if you look at recent few months, the A-share index, which is the domestic stock index for China, right? It actually started the year quite badly. It was down as much as over 5%. But if you look at it today, it has actually done a reversal, and today is trading in positive territory. So I think that is people recognizing that well, there may be an inflection point in terms of the government's stance on some of these things, and also possibly they are recognizing that the valuation wise, the overall fundamentals wise for the China market, it is probably too cheap to ignore, and possibly from what I hear, also people are probably a bit light on China stocks. So if they are light, then they better buy some, right, to maybe reallocate and rebalance their portfolio. So basically, that's the overall case in terms of the economy, in terms of possible catalysts. Yeah, that I think definitely today it is a you can definitely consider looking at China with a bit more optimism now that some of the troubles have been priced into the market. Thank you. Right. Hope that wasn't too long explanation.
Thank you so much for the comprehensive sharing. Right now, we do have quite a few great questions in the Q&A segment. First of which, by HC, in terms of valuation, right, HS is currently cheaper than the same China exposure. So, though we have seen a minor rally in recent days, but why AHS? I believe you have roughly mentioned a little bit about earlier, but maybe we draw a comparison between AHS and HS.
Sure. Yeah. So for those who are not so familiar with A shares versus H shares, so A shares and H shares can be basically the same company, like PetroChina. PetroChina, which is a state-owned energy company, right? They list on both the mainland China on the Shanghai Exchange as well as in Hong Kong. The one that is listed in mainland China is called an PetroChina A share. H share is the one that is listed in Hong Kong, right? So basically the same company, but they list different classes, right? So the H shares is basically to make it available for international investors to invest, right? That was introduced when China was opening up over the last maybe 20, 30 years ago, right? H shares versus A shares, the difference in valuation. The thing is, it has always been there for quite a while, but people expect or people thought H shares is cheap and versus the A shares, and therefore it is a reason to buy. But if you look at the difference or the discount of H shares, maybe in terms of PE or PE, for example, right, it has never corrected over the past years. And the reason is simple because the types of investors in them are different. The A shares are catering more to the mainland retail investors. The H shares, on the other hand, will be catering to more the international investors. So the investor set is different. Even though, of course, as a purist, you would thought for the same company, they should be trading at the same valuation. But in practice, this does not happen to be the case, right? If you look at it more fundamentally, you would say that the A shares probably would have a bit more support from the overall mainland investors, right? Why so? Because there is great. The mainland investors find it difficult to buy outside of China, so they would typically buy on the mainland. International investors would be usually buying the H shares on Hong Kong. International investors, they tend to have firstly more options. They can buy outside of the H shares into other markets easily, right? Capital is very mobile. Secondly, of course, it is that they tend to be very more fickle. So the capital is mobile, right? So it tends to be, it can move from this. So some of this is also priced in when you look at the H shares valuation, right? So these are some of the considerations. Well, and lastly, more generally, if you look at the the mainland shares as a whole, right? They are more owned by the mainland mass investors. So consider this case, would the government in framing their government policies or their market support framework, would they think more about A shares or which is invested by their own captive audience, or would they be more interested in supporting H shares, which are the ones that is mainly more for international investors? I leave the answer to you.
Thank you so much. Adding on to these, right, there was another question came from Ivan. Okay, with the kind of like publicly stated policies about common prosperities, right, and the fines that has been on the big tech like Baba and Tencent and all this, how are we going to expect a good return from our investments?
Yeah, so coming to that, well, I was looking at, so I was planning to talk about the various China shares that's listed on different exchanges in this next slide. A shares is the ones that's in the domestic exchanges on the Shanghai and Shenzhen exchange, right? So You have all these names that are listed there. H shares, like I explained, you also have quite a lot of similar names that are listed as H shares. Then you also have tech mega caps that tend to be listed offshore and on the Hong Kong exchange, such as Tencent, Alibaba, Meituan, JD, all these. The tech platforms, the tech mega caps tend to be listed on the Hong Kong exchange. And then lastly, you also have those that are traded as ADRs, depository receipts in the US, namely in New York and Nasdaq. So Alibaba has been listed there, Pinduoduo is also listed there. So basically, I think in recent years, it seems that a lot of the regulatory pressures have been on offshore shares. Right? And that is the one that troubles investors nowadays, right? Alibaba and Tencent, right? Government has pressed down on them quite a lot, right? It does, if you look at the overall performance of the A shares versus the overall shares, China shares listed everywhere, right? So this gives a good gives you a good appreciation for the performance of the various China shares over the last 10 years. Right? What I want to show here is the red line, which is basically China A50, right? It's the leading 50 companies listed on the China mainland exchanges, basically Shanghai and Shenzhen. So over 10 years, if you invested in this index, let's say you started with 1.0, $1, right? Well, at least you made something, right? You made 80% over 10 years, right? So from $1 to about 180. Now, if you invested into one of these gray indexes here, one of the gray one is China All Shares. The second one is China, right? Both by MSCI index. So these two basically are indexes of China shares that it tries to capture all the China shares listed, irregardless of which exchange. So it could be mainland exchange, it could be Hong Kong, it could be US, right? Well, for these two great indexes, what you can see that basically over 10 years, due to some of these recent troubles about regulatory concerns and the trade war and so on, right? Basically, an investor in 2014 in MSCI China or MSCI China All Shares would have basically earned close to nothing over 10 years, right? Compared to if he invested into just domestic shares, A shares, right? As represented by the red line, at least we have got 80% back. Got 80% return on his investments, right? So 180% total. So basically what I'm trying to say here is this, that track record of the A shares has been much better, right? For the same reasons that I was talking about just now, right? So it is a market that has been more for domestic investors, right? So I think another possible catalyst going forward is when A shares open up more to the global investing public. Well, I think that would definitely be the next catalyst going forward, right? When China opens up the A shares to a bigger audience, well, I think that would be interesting to watch, right?
Thank you so much. Building on to the previous question, there's a short question over here. We have H shares is a subset of A shares, and some A shares are not H shares, right?
Yes, that's correct. In fact, many A shares are not H shares, because the H shares tend to be more of the SOEs, the state-owned enterprises that wants to internationalize, right? So that's why you can see that the major SOE banks, major SOE energy companies, major telcos, SOE telcos. Examples of these names will be like ICBC, ICBC, China Construction Bank, Agricultural Bank, and so on, right? So they list on both China A shares as well as H shares. Same thing for PetroChina, both in mainland and Hong Kong. Same thing for China Mobile, both on mainland as well as Hong Kong, right? There are many A shares actually that are only available on the mainland China market, right? And these are names, the major names I think I also show here: Huizhou Maotai, right? CATL, BYD. Well, it lists on both A and H nowadays, right? But a lot of the major names you may not be familiar that are just listed on China mainland, right? And these actually also give exposure to China's economic transformation. You have a lot of names that you can't invest through Hong Kong that give you exposure to high-end manufacturing, to healthcare, to technology. And by technology here, I don't mean technology platforms, but technology such as solar renewables, right? Such as robotics, such as AI. They are not available on Hong Kong, and they only list in A shares. Later, when I talk about this product, maybe I can give you a bit more insight into some of these names.
All right, thank you. Next question will be like, what are the key advantages and disadvantages of investing in A shares right now in this IOP, rather than through the Hong Kong Stock Exchange with a much higher liquidity?
Right. Investing into the A shares through the Hong Kong exchange, right? Okay. Yes, of course, that is possible. Although I'm not sure if many people are set up to do the so-called stock connect that enables them to buy China A shares, right? Yeah. So I mean, just to take a step back, so it used to be that A shares was not available to global investors completely. Well, but in 2015 or 2016, the Hong Kong established a stock connect with mainland China, right? So after that, major companies on mainland China were available for so-called northbound trading for international investors who trade from Hong Kong exchange, right? So that is the so-called stock connect. But of course, definitely, I think you can buy individual stocks through the stock connects to get exposure to China A shares. The ETF is basically just another way for you to get exposure to A shares. Some of the example or some of the advantages, maybe I'll probably go through a bit more detail later when I talk about the product. Basically, is this that this ETF that we are listing in SGX basically is in Sing dollar. So it is convenient for Singapore investors if you want to buy into China A shares and you have natural Sing dollar exposure. You don't have to convert your Sing dollar to Hong Kong dollar and then buy or convert to CNY in order to buy into China A shares through the Hong Kong Stock Connect. So that's a very circuitous route, right? Got to convert and then got to go through the Hong Kong exchange to buy the A shares. Well, you can actually just buy an ETF that is listed right here in Singapore, right, to get exposure to China A shares. Secondly, of course, there is that thing about diversification, right? So what do you hope to achieve out of buying the A share directly, right? Unless you have quite a fair bit of conviction on certain A share stocks. Or instead of that, why not consider buying a basket of leading A shares directly through an ETF that we are offering today? Because by doing that, you get exposure to China's growth. And these are sector leaders, 50 leading companies. So you are not like getting exposure to unfamiliar names. You probably, a lot of the names might be familiar or semi-familiar to you. And because by sheer size, they have been mentioned here and there. So you do get acquainted with them and there is some level of comfort because these are quality companies. So probably I also take the chance to talk a bit about this ETF that we are talking about today. So I just give a broad overview of what this ETF is about, right? You can see from the name actually, right? Phillip China Universal MSCI China A50 Connect ETF. It is a partnership between two fund management companies, ourselves, Phillip Capital Management, and China Universal Asset Management, which is one of the largest mainland fund management companies, right? And the index that it is tracking basically is MSCI China A50 Connect, right? The index itself, you can see what it is about. It is about China A shares, right? So that's why it's China A, and it's investing into the 50 companies. In this case, the 50 leading companies on China's A share market. Yeah. So it's basically what we are listing on the SGX is this ETF. It is a feeder structure. So feeder structure meaning that you would primarily get exposure to this index by buying into just one position. That one position is basically the China Universal MSCI China A50 ETF, which is listed on the Shanghai Exchange, right? And this ETF is a 1 billion Sing dollar assets ETF. It's already been listed there for the past 3 years on Shanghai Exchange. So basically, by buying into that directly, that will be just the main position, right, for our feeder ETF. By buying into that directly, basically, we can get exposure vicariously to the 50 stocks held by this ETF. Yep. So what does this ETF basically give exposure to? It gives exposure to core China, right? Core China meaning leading companies in China, 50 of them. And I should also talk about what this index is about. How is this index compiled by MSCI? This index is basically starting from China A Shares Index as the parent, right? So basically the starting point for this index that we are benchmarking is an A Shares universe, right? And then after that, it starts to, how does it compile the 50 companies? Basically, it starts by selecting two leaders in terms of the market value. It selects two leaders from each of the 11 sectors. So that's 2 times 11, that's 22, right? But the remaining 28 constituents are basically the largest companies that are remaining, irregardless of sector that they belong to. So finally, you get 22 plus 28, that's 50. So that's how you get the so-called the 50 leading companies that's inside this MSCI China A50 Connect. So that's basically what this ETF is about. It's going to be listed on the Singapore Exchange. There will be right now during the offering period, which ends on Wednesday this week, right? So hurry if you haven't done so. It is available for subscription in Sing dollar. So you can go through Phillip Securities, for example, to subscribe. Once it lists on the SGX, then you have a Sing dollar counter and a US dollar counter. So it will be quite easy. If you have Sing dollars, you can also, after it lists, you can also buy off the exchange. But it won't be as advantageous. Why? Because when you buy it on the exchange, you have to pay commission to buy through a broker, right? So right now, if you subscribe, there is no commission. And on top of that, typically when you buy on exchange, there's a so-called bid-ask spread, right? So when the market maker makes a bid-ask spread, then you also have some implicit costs that's within the quotes, the bid-ask. If you subscribe now, you are basically subscribing at what it is, which is the starting price is $1. Some other things about this ETF, very cheap management fee. So this ETF is 0.01% per annum, right? So you would find this management fee anywhere for other ETFs on the Singapore Exchange. Okay. So offering period, right? Officially is closing on 14 March, but the participating dealer closes earlier on 13 March. So do hurry if you want to subscribe, because by Wednesday, it will close. And it lists next Wednesday on the Singapore Exchange. So this is some of the information about this ETF that we have launched for offering. Okay, and basically that gives it gives an exposure that is unlike any other ETFs that is available on the Singapore market right now. Right? That's another thing that I also want to emphasize. Because core China is not the leading 50 companies on Shanghai and Shenzhen Stock Exchange. No other products or ETFs on the Singapore market right now does this. Okay.
Okay. Let's take the next 15 more minutes to answer multiple more
Sure.
questions before we move on into like how to subscribe and all these things. There are a series of similar questions regarding currencies and dividend. So maybe we can answer a few questions at the same time. So first, with the weakening of renminbi likely to continue, how much will this eat into the return? Secondly, what kind of yield is estimated for this ETF?
Sure. So first of all, this this is not a currency hedged ETF. So in common terms, basically what it means is that well, if the renminbi weakens, while the share price of the underlying 50 constituents remain the same in renminbi terms, but when you convert back to Sing dollar terms, yeah, the Sing dollar price will be lower. So long and short of it, you expect the share price to drop even if the share price of the 50 constituents remain the same, but the renminbi weakens, then the Sing dollar ETF price would weaken. Oh, 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 OK， 好，哦，是啊，哦，哦，OK， yeah, sorry, yes, yes, so basically that is question one. Second question is that, yeah, so there would not be a dividend for this ETF because this dividend is not a dividend ETF. It is more of a, a product that gives exposure to growth in China. So long and short of it is there's no distribution. Of course, there are dividends by the underlying 50 constituents inside the index, but we do not look to pay out any distributions for the ETF itself. The reason is because it's not marketed as a dividend product.
I understand. How about okay, building on to one of the questions about dividend, right? Like one question is, do we need to pay tax to China government if we wish to sell?
As far as I know, well, basically when we do the when we hold the ETF, we will be just holding the master ETF, so there will be no gains when we sell the master ETF.
Okay, sure. May we know what are the 50 constituent stocks for this?
Sure. Yeah, but before that, maybe I just give an understanding of the index in terms of sector breakdown, right? There's a one. Yep. Yes. So basically, I show it on the left-hand side. You can see the sector exposure for this index as of end of December last year. You have financials, IT, consumer staples, industrials, and so on. So basically, it's because of the index methodology that you see here, it is quite balanced. It is quite diversified across the major sectors. So you don't really have one major sector that is dominating the whole index. No single index is more than 20% of the total. Secondly is sector leaders. So you will see that the sector exposure is quite well balanced. Sorry, the names are quite familiar. Sector names, Guizhou Maotai, CATL, Zhiqing, and so on, right? So some are familiar, some are not so familiar. So these are the top 10 constituents. Some things to note. So for example, information technology names that you see here are not the typical IT names that probably people associate with like Alibaba and Tencent. On the mainland, some of these major names would be like Luxshare Precision, which is a major manufacturer of parts for big names like big MNCs like Apple. You have Foxconn Industrial Internet, which is basically an enabler for smart factories, smart automation. So they build things like sensors, robotics, smart manufacturing, smart cloud computing, right? And finally, Longing Green Energy. So Infotech here, this one is it's actually the world's biggest manufacturer of solar panels, right? So it's fully integrated from raw material all the way to end product. So some of these, I think, it does give you some of the flavor of the major constituents. Of course, if you wanted to look at the 50, I don't have here the 50 constituents, right? Yeah. If you wanted to appreciate for yourself. So the top 10 was the ones that I talked about just now on the left-hand side. Then you have Shenzhen Minwei, which is a medical equipment, BOE Tech, one of the probably the world's largest display panel manufacturer, Ping An Insurance, Kingsoft is a software company, right? Some infrastructure companies like Beijing Shanghai High Speed Rail, right? Some of the banks like Agricultural Bank of China, ICBC, and so on. So these 50 constituents, if you were to look at their total market value, right? Actually, I remember offhand is probably the total value of these 50 constituents alone comprise almost about 1/5 or 1/4 of the total A shares market on China. So you can see how big they are.
Okay, probably we will go with the last last two questions for now. We'll do it together. Okay, under the Q&A, right, one audience was sharing that China GDP is at 218. Sorry, China's debt to GDP is at 286% as of this year, January 17. So why is the difference so big in all this? And lastly, maybe we share a little bit about the fund fees as well, like the master feeder fund, and is there any spread cost and all this? So first, debt to GDP. Second, all the cost to it.
Debt to GDP, so what I was showing there is basically the debt to GDP of the central government. If I interpret your question, you're asking whether is this the overall debt for China? No, of course not. This is just the government debt. Of course, there's consumption debt, there's company debt, and there's local government debt. So what China is doing now, because there's some concern about local government debts in some of the provinces, especially the inland provinces, right? They have quite a fair bit of debt. What the government is doing now is basically is borrowing against the credit of the central government to help some of these local governments, which have been affected by the real estate problems. And that should actually help to solve some of the issue, because the central government has a much more debt headroom to help the local governments. Secondly, I think if I were to share the feeder master structure that I was talking about, I was saying that this new ETF that we are launching on the SGX is a feeder. It will basically hold primarily the master ETF listed on the mainland in Shanghai. So if you look at in terms of the management fee, I would emphasize that 0.01% is the feeder. But because the feeder fee is to the master, so it also has to pay the master management fee. That master management fee is 0.5%. So if you wanted to understand what is the total management fee, is basically 0.01 plus 0.5%. So basically total is 0.51% to the end investor in terms of the fee that you incur. But note that this applies for all the other feeder ETFs on the Singapore market. It's the same concept. Thank you.
All right. Okay, with interest of time, I would start to share about the subscription steps and all this. And at any point of time, if you have any other questions, you can email to etf@phillips.com.sg. Later, I'll share with you a little bit more. So let me share my screen over here. All right, just want to seek confirmation. If you guys don't see the landing page, do let me know. So some of the key things that we need to note is that this IOP will end in 2 days' time, so by Wednesday, 5 p.m. And some of the information about the fees will be there will be zero commission for most account. Okay, the minimum is 1,000 units. For most account, there will be zero commission. Let's say if you're using a cash management account, which is KC account, there will be a transfer fee of $10, which is the fees to transfer between your account and the CDP account. But let's say if you were to subscribe more than 5,000 units, then this transfer fee will be waived off as well.
I can try to ask.
Okay, so some of the key steps about how to subscribe. So once you log into your Poems account online via the laptop, on the left side you will see a online form. After online form, you go to IPO subscription. Under this IPO subscription, you should be able to see a ETF name, and you click apply. Once you apply, click put in the amount that you want to subscribe to. So from 1,000 and above. Okay, and then after which you can start to agree and read the declaration, all this, and re-enter your password. Then you can submit right after that. So this is generally how the whole the subscription steps will be. Let's see if we do have any other last minute question, if I can answer. Okay, one person shared on the chat who is managing a master ETF. So it's China Universal. So if we will look at the in the future, let's say in the future, if you are also keen for future IOPs, generally the names will be on top of the ETF name. So in this case will be Phillip, China Universal, MSCI China 850. So China Universal is the one who is managing the master fund. Okay, I guess we will end off the webinar as of now. If you do have any other questions, do send an email to etf@phillips.com.sg. I will send the email into the chat box. So if you have any question, you can just email to this email. Thank you so much for your time, and hope to see you soon. Bye.